sure within those funds is you've got, so for example, 3 managers are in the global value fund, 7 in the global quality, and 4 in the global growth. And the reason for that is because different managers, as another level down, approach value in different ways, approach quality and approach growth in different ways. So it's really important that we have a mix of those different managers. And what it means essentially is that if one of those managers has a tough time of it, the whole fund doesn't necessarily suffer. So moving on from that, this is a good example of a change we've made recently, given these style shifts that are around. And we've created what is almost an asset. We're creating what is called asset class building blocks. So essentially, if you imagine that we have a UK equities building block, we'll have a global equities building block, we'll have a fixed income building block, and we'll have an alternatives building block. And what we're trying to do within these building blocks, as you can see in the bottom right of the image on the screen, is we're essentially trying to ensure that we've got the right blend of styles. So you'll note there you've got 2 managers in the quality, 2 managers in the growth momentum style, and 2 managers in the value style. And if you have that blend, it means that A, you've got the right diversification, and B, you're going to get very consistent and smooth returns over time, which is really what we're trying to achieve for our clients. We're not trying to achieve very, very volatile returns for our clients over time. So, you know, if you just have funds where, or you just have a portfolio or a fund where it's just weighted towards one of those styles, it can be very, very volatile and move about a lot over time. So that balance is very, very key. Now, the other thing I wanted to move on to is, so that style change that's happened in the market is, I want to move on to inflation. So there's been a lot of media coverage, a lot of murmurings about inflation, essentially based around the fact that there has been a lot of stimulus that's been put into lots of different economies from around the world. And as a result, a lot of that stimulus has actually gone directly into the pocket of the consumer. Okay, so what we're almost seeing at the moment is in certain economies around the world, is you're almost starting to see this, what we would call reopening inflation. There's a sudden surge in demand for lots of different activities, and naturally that's driving prices where the supply side can't keep up with that. So focusing on the UK first of all, what I wanted to come to on here was the Bank of England. This is essentially the Bank of England's projection for inflation over the next sort of few years. And the key is that likely it's probably only going to be a couple of percent. And that's really key, because as much as lots of economies around the world are saying, okay, we're likely to see a bit of a spike in inflation over the next 12 to 24 months, long term, it's still going to be kept realistically. It's still realistically going to sit at a circa 2%, a circa 2%, 2% weight. So inflation is going to increase in the UK likely, but it's not necessarily going to go crazy. It's just going to be part of this reopening inflation where we see that big demand. Now, at the same time, we can't be ignorant to it. And the inflation is obviously not just in the UK economy, but it's prevalent around the world, especially in places like the US, where we've seen, I hate to use the word unprecedented because so many people have used it over the last couple of years, but we have seen an unprecedented amount of stimulus into places like, especially places like the US. So how do we deal with that from a management point of view? Well, in our fund range, we're active investment managers, okay? So all of our funds, we do have in one fund a strategy which has a small tracker in it, but predominantly in all of our funds, we have active managers. And what that essentially means is that those active managers can approach issues around inflation in different ways. And some will be more concerned about it than others, depending on their style of investment. So a couple of examples I wanted to give you was, the first one was Sands Capital. Now, Sands Capital sit in a couple of our global funds. And what Sands do is they buy more quality businesses. So essentially they're buying businesses which are, first of all, leading in their industry. So they've got competitive advantages and they're in industries where there's quite high barriers to entry. And what they've also got is they're selling needs as opposed to wants. So they're not selling discretionary items, they're selling essentials to people. Now, if you've got a combination of you're selling essentials to people and you've got a very competitive advantage in your industry, and what you've got at your disposal is you've got pricing power. Now, why is that important? Well, the notion is that if inflation kicks in over time, interest rates will go up. And what that ultimately means is that people will have less money in their pocket. But if you're in a business which has a competitive advantage and sells needs, regardless, you've got pricing power in that industry. So you're still going to get your customers coming through the door. On the other side of that, you've got one of our managers called Artisan. And what Artisan essentially do, they've been talking about their fund recently. They've got a big position towards financials. So if interest rates go up as a result of inflation, financials will tend to do better themselves because of that interest rate rise in the banking and the financial industry that they're in. So essentially, they're positioned towards financials, and also they're also saying that as much as you've got this notion of a lot of money in the economy, which will cause inflation, what a lot of money in the economy means is that you've got quite a strong economy and you've got a lot of transactions that are going on. So businesses that they hold, such as Visa and MasterCard, are going to do quite well in that environment because there's a lot of transactions passing through their business. And they refer to those businesses as what we call toll booth businesses, i.e. continuous transactions are passing through them in the current environment that we're in with all this stimulus, which means those businesses will likely perform well. So that's just a small insight into how an active equity manager in our funds would approach or deal with inflation. And now I wanted to talk about the fixed income side of things. So in the fixed income space, you've essentially got, to narrow it down, you've got government bonds, you've got investment grade bonds, and you've got high yield debt. Okay. Now, government bonds will suffer a lot more in an inflationary environment, and investment grade will suffer a little bit more than that. A little bit less than that, because at the end of the day, they're safer assets and they're a lot more sensitive to rises in interest rates. Okay, so naturally, the coupon or interest rate on a government bond or an investment grade asset is a lot smaller than, say, on what we call high yield debt asset. Because with the high yield debt asset, what you do is you have more credit risk, because what you're essentially doing is you're investing in debt of businesses which have got, a worse credit rating than investment grade and government bonds. What that means, you get a higher interest rate and you get higher return over time. So why is that important? Well, that's important because we need to ensure that we've got the right balance in our funds and our portfolios towards those different levels of debt. So the example you can see in front of you is a recent change we've made to our diversified bond fund. And what we've actually done is we've removed a manager called Brigade, and we brought in two new managers called Blue Bay and Man Group. And the idea behind doing that is we want to have the fund, we wanted to bring in managers into the fund which were more flexible and could take advantages of short-term changes in the market in terms of, and be quite reactive in terms of things like interest rates. So what this fund will do over time is the managers will have a lot of flexibility. So as much as you can see there, you've got investment grade and high yield debt. The idea is that the fund will over time have the right balance in the right environment to deal with the effects of inflation. Now, ultimately, what's really important is how we deal with that in our